While we often use the words investing and saving interchangeably, it's important to keep in mind how investing is different from piling your money into a checking account. Generally speaking, when you invest, you're buying an asset. This asset can be anything: real estate, a piece of a company, a bond. But what makes this trade an investment instead of a traditional purchase is that the exchange is expected to generate a benefit that is greater in value than what was put in. But make no mistake, this is still a purchase, and when it's over, you no longer have cash. It's important to keep this in mind, because while having a productive investment might seem preferable to having cash, you're still giving something up. The attractive thing about cash is that it can be easily exchanged for other things. In technical terms, it's a liquid asset. On the other hand, investments are illiquid, with some being more illiquid than others. The degree of liquidity of an investment is important to balance against the cash value of your investment. Looking only at the dollar amount could hurt you in the long run. For one thing, there are often fees associated with selling an investment, meaning that the frequent selling and buying of investments can cost you over time. In addition, selling an illiquid asset quickly might require you to offer a cheaper price than what you should be able to get if you take your time. Even if it doesn't cost you much to do it, moving money in and out of investments cuts out a good chunk of your potential earnings. Since compound interest is what makes traditional investing so powerful, moving money out for a time eliminates all the compounding happening when it isn't there. There are a few reasons why you might move money out of investments before a set end date. The first is that you had an unanticipated expense and didn't have the cash to cover it. This kind of situation is why it's important to have an emergency fund that covers 6 to 12 months of expenses and that you can use instead of liquidating your assets. So developing that is a prerequisite to investing. Of course, if your income is too low to be able to develop an emergency fund in the first place, finding ways to increase your income or decrease your expenses is more important than any money that you can make through investing. On the other hand, you might be selling your investments to buy something that you want, rather than something that you need. Because of the lost potential income, this purchase costs you a lot more than the stated price in the long run, and in that sense, it's important to develop discipline with your personal spending if you want to be serious about investing. Finally, you might be doing short-term trading of assets, the most extreme version of which is known as day trading. Those who take this approach frequently buy and sell assets, specifically with the goal of making a profit off of short-term price fluctuations, rather than long-term trends in the market. However, short-term fluctuations are harder to predict, so the possibility of losing money on your initial investment is much greater. Since many definitions of investing describe it as a process with a reasonable expectation of gain, it's arguable whether or not short-term trading is even investment. Of course, all kinds of investment are speculative in some sense, but more traditional approaches, like the purchase of investment-grade bonds or the long-term holding of diversified stock portfolios, are very likely to be profitable. In that sense, even if investment is a separate thing, it can be a very useful tool to supplement saving, so we often talk about them as though they're the same thing. While the same can't be said for speculation, that doesn't mean it's bad. Just be sure to think of any of your more speculative ventures more as informed gambling than as enhanced saving.